little bit. The foundation now has a broader set of responsibilities than its historical responsibilities. I think we're well enough into it now that it doesn't feel new to us, but I know it still may feel new to all of you. And I'll talk a little bit more about that shift in responsibilities in a moment, but that's what's broadened the agenda from simply an investment sort of review and overview and discussion of our investments, but to also include the success that we're having in fundraising, representing our new responsibilities and by far the majority of our staff. And again, more on that later. So our agenda today is relatively straightforward. That was my welcome, by the way. Sorry, in case you missed the slide. The welcome is officially over. Now I'm going to talk a little bit about the agenda. I'm going to provide a bit of an organizational overview. We did this last year, and I think it's helpful to give you an update. A lot continues to change in our organization. We're very focused on, or have been very focused on, growth, and we're really starting to get to the levels that we wanted to. So more on that in just a second. And then we'll have a review of our campaign results and fundraising results in general from Amy Noah, and an investment overview from both Brad Johnson and Jean Lohmeyer, who will give a market overview. So we'll wrap up with a little Q&A at the end, and so that's the agenda for today. And if that's not what you expected, I apologize. So let's talk about the organization. And I'm always uncomfortable holding a mic, walking around, but I can't just stand behind the podium. So, we talked about it last year. It's been true. On March essentially 1st of 2021, responsibility for fundraising at the University of Oklahoma moved from the university itself to the foundation. And there was lots of really good reasons associated with that. The biggest reason, the most significant reason, was a commitment that the foundation made to the university to invest significantly in fundraising resources. And while the university had success in fundraising, we felt, and certainly the leadership at the university, President Harris, felt that there was tremendous upside opportunity from making an significant incremental investment in fundraising. And I think Amy, and she'll share this with you in a moment, and her team are demonstrating that was true. So the incremental investments that we're making in fundraising is paying off in a very significant way. Our historical responsibility, as all of you know, have been the sort of gift processing and investment management side, and that's the reason that we focused on investments and those results. That was the way that we added value to the University of Oklahoma, the most significant way that we added value to the university. Now we add value through both excellence in fundraising and excellence in investment management, and thus the agenda for today. We think we're obligated to demonstrate to all of you how the investments that all of you have made in the university will continue to pay off through the work at the foundation. And so this represents that shift. Our mission is pretty straightforward. I'm not going to read this to you. Our charitable purpose is the University of Oklahoma. We don't exist other than to serve the university in this way. And part of the rationale for the move of fundraising was to close the loop. Historically, again, the university had been responsible for fundraising, so those processes lived inside of one organization, and all the sort of back office and asset management processes lived in a different organization. And while we always had a terrific working relationship with the development staff, the fundraising organization, it was much more difficult to integrate those processes. And so this move allows us to have a more holistic mission in the service in our service to the University of Oklahoma. And I want to point out a couple of things. Historically, there's a line in there that says facilitates and manages philanthropic activity for the University of Oklahoma. Facilitates is a new word, and so reflects the purpose of our organization. one of the reasons that we have this meeting every year is to demonstrate that our approach to asset management and fundraising is with the utmost in integrity, so that all of you trust when you share with us your successes, that you can trust that it's going to an organization that will steward your intentions as well as your money extraordinarily well. And every single day we're reminded of and think about that purpose. And it's a legal responsibility, but more importantly, and I say this all the time, it's a moral obligation that we have to all of you. And so we take it very, very seriously. And again, part of the reason for this meeting is to be transparent about what we're up to. Our organization has gone through tremendous change over the last, call it 2.5, 3 years. And as a result, our focus has shifted between, call it summer of 2020 and really through 2021. Most of our organizational focus was on transitioning from a limited scope mission to a much broader scope mission, inclusive of fundraising. And when you think about what an organization does to transition into a new organization, moving people from one employer to another employer, making sure that they're tucked in from a benefits and a compensation perspective. There's a lot of sort of organizational dynamic, and that dominated our focus really through the end of 2021. In 2022, and it really started in 21, and maybe even a little bit, we cheated into 20, our focus was on growth. And we've grown our staff. The foundation staff in February of 2020 was about 34 people, and our staff today is just shy of 200. We'll get to 200. Almost all of that incremental growth is related to not only bringing over the fundraising responsibility from the university, the folks who worked on that, but growing it substantially. And we've nearly tripled the number of frontline fundraisers, so that we can extend our reach with regard to our alumni and friends base. We always did a terrific job of fundraising with a very limited population, limited by our capacity. And we've simply grown that capacity, made a significant investment to grow that capacity with the belief, and again, I think we're proving that it will pay off for the organization. Again, more on that later. Really in 23, fiscal year 23, our focus has shifted to execution. So we're sort of reaching peak growth. Transition is more or less behind us. There's a couple of elements of transition that are left. Most of our growth is behind us at this point. And now we're really, really focusing on execution. And we've got, as you all know, tall aspirations with regard to the kind of impact we believe we can have on behalf of the University of Oklahoma. And am I flipping something? Because the screen back there is going dark. No, everything's fine back here? Okay. And so really our focus now is shifted meaningfully to execution. We have a strategic plan in place. We've harmonized our strategic plan with the priorities associated with the university strategic plan on all 3 campuses now. We have clear input in terms of what the priorities are, not just at the institutional level, but also within the individual colleges. Tremendous amount of work was put into building, which I'm sure you all have been exposed to, case statements that support our fundraising campaign. Really, that was where a lot of the strategic plans got harmonized within the university, but also with the foundation. And so our focus going forward for certain is on execution. And that's how we pay off on the promise of this change to the university. Near term, our priorities are fairly straightforward, and you're going to get to hear about more of that in just a second. We need to continue fundraising momentum. We're very focused on the campaign goal. Amy will share more on that here in just a second. We need to scale our investment, continue to scale our investment office, And there's a sense that the current market climate may create opportunities for us, and we want to be able to seize those opportunities. We will continue to focus on the execution of our strategic plan priorities. Part of the management system for the foundation is that we work very closely with our board of trustees to develop our strategic priorities, and then they hold us accountable for executing those. We report to them regularly on how we're doing against those plans, and have lots of dialogue when we're coming up short on specific priorities. And it's a pretty fluid process, but there's a lot of accountability built into that. So our focus will be on executing the strategic plan. That includes financial milestones, and financial milestones in this context is both, are we achieving the fundraising results we expect at the pace that we expect them? When you launch a 7-year, $2 billion campaign, you don't wait to the 7th year to figure out whether you're going to make it or not. So Amy is ruthless in her tracking of our progress in that regard. I'm probably a little ruthless myself. And so we're very focused on meeting those milestones. In addition, we put forward a financial plan that allowed us to capitalize our growth, and we need to stick to those expense expectations and revenue expectations, and we're doing that as well. And then the focus, really, our execution is focusing on supporting the strategic priorities of the University of Oklahoma. For the first time in beyond the time that we can all remember, let's say, the university has a clear-eyed set of strategic priorities for all 3 campuses and as an institution as a whole. And in almost all cases, those strategic priorities require capital in one form or another. And so our focus isn't simply on fundraising, it is fundraising in service to those strategic priorities, because the university has said those are the things that have the biggest impact with regard to the institution long term. And so we're kind of helping complete that circle with regard to the university's strategy and strategic plans. And so we play a very important role in that regard, and that'll be our focus with regard to execution. So that's it for me. So, which is to say, it's about to get a lot more fun. And so I'm going to transition to Amy Noah. Most of you know her now. Amy joined us in April of 2021. I think it's fair to say that you've had an extraordinary impact on our university. She brings an awful lot of energy, but also expertise to fundraising, and it's terrific to have her here. So with that, I'm going to turn it over to Amy.
Thank you very much, Guy. Last year was my first opportunity to be in front of this group, and I admitted my own shortcomings when I arrived in Oklahoma, that in the first week I asked President Harris who Bob Stoops was. It was a low point, I will admit, and especially when he asked me to repeat the question 3 times. But I feel like today I've come full circle, because after 2 years of being here, today I was lucky enough to finally meet Paul Massett, a legend in our world. Yeah. So he's promised me a lunch date, and we're going to talk about cattle, and I'm really looking forward to that. It's a pleasure to be here. I'm extremely happy to have an opportunity to give you an update. Guy mentioned several times, the campaign and the investment that the university has made in advancement, and so it is a true privilege to work with this team. We are continuing to build the team, but I think we're getting close to a place where we're in steady state with this organization. I will share with you a little bit about this path. Guy mentioned that in March of 2021, the foundation assumed responsibility for the fundraising enterprise, and that allowed us to move that team over. I think the other key piece, and of course he talked about the financial commitment, but In order for the advancement organization to be successful, the university and the foundation knew that it was going to require significant commitment, and that has come in the form of 3 times the budget expenditure. So we're grateful that that's allowed us to do the work that we wanted to be able to accomplish here. Additionally, I will share with you, I cannot see that back there, so I'm going to have to turn around a little. You can. Okay, well, I'm going to read some details to you. I've got most of these, but at any rate, we've been able to grow the team, as Guy mentioned. Another key detail that I want to make sure that everyone in this room is aware of, last August, we actually transitioned our athletics team over, not the full athletics organization, obviously, but those individuals within the Sooner Club who were doing work to help us raise dollars. And so those individuals, Matt Shaper-Cutter, Kendall Meyer, Dylan Stanley, Caitlin Montgomery, that entire team, there were 10 of them, joined our team, and they're now part of the foundation team. So we're grateful to have them. When we think about what were the end goals here, we really knew that we needed to get serious about a couple things, one of which was our database and make sure that we knew where people were and that we had relationships. So I will tell you that we've invested a ton of time and energy in thinking about that. We still have work to go. Bonnie Kennedy and her team have been incredible partners, and we're grateful for that. But because of that and because of the investment in the organization, we literally find ourselves at a place where we're managing double the amount of relationships, in fact, far more than double. So when we first started tracking our progress in March of 21, we were managing effectively about 2,700, almost 2,800 relationships. Today, that's over 7,000. And so that comes in large part because of us being able to add staff, us being able to equip the colleges and units with fundraisers, us being able to, have a more succinct message and really help do what the university knew that they needed to do. The real reason, when people ask, well, why did you want to have a campaign and what's the importance of the campaign? For us, it was a perfect storm because the foundation made a commitment to assume responsibility for advancement. The university had a strategic plan. And I joke with President Harris often, if you read the strategic plan and if you do any kind of rough calculation, we probably need to raise about $9 billion, but we're going to round down and hit $2 billion because we think that's a place where we can be successful and we can make a huge impact for the university. So we announced the campaign on October the 14th. Most universities, when they announce a public campaign, they announce at the halfway mark of time or the halfway mark of dollars. We were at neither. We were about 2 years in because we were starting the campaign on July 1st of 2020. And we knew it would run through June 30th, 2027. And we were just over the 2-year mark, and we were at $600 million at the point that we announced, not half of the $2 billion, but at a place where we felt like we needed to share with everyone that we were in a capital campaign. The last comprehensive campaign at the University of Oklahoma had been very many years ago. There had been smaller campaigns and more collective efforts, but to say a comprehensive campaign had not happened here in over 20 years. So that was part of the reason why we felt like it was so important for us to announce. We announced with the highest priority being need-based aid. It's the thing that President Harris talks about often. It's a place in which we know we have to be more competitive. We hear often from students and prospective students and their parents who have figured out the entire financial cost, and they find themselves short of maybe in some cases as little as $1,000, $2,000. And for them, that's a barrier. They cannot make that commitment to send their son or daughter here because they feel like that gap is too great. And so we are working with the university to make sure that we raise money for dollars, not just at the undergraduate level, but at the graduate level, because it's so important to one of the most aspirational goals of the strategic plan, which is reaching AAU status. And we know that we have to invest in our graduate enterprise, and then we also have to invest in faculty. And so those were the primary functions of the campaign. Each of the colleges and units, of course, are going to be investing in faculty and students as well, but many of them have their own priorities. And so we're going to talk a little bit about some places in which we've been able to make an impact there. If you couldn't read the previous slide, I'm confident you can't read this one, and I'm getting a lot of shakes of heads. So what I'll tell you that this says is, from fiscal year 11 to fiscal year 20, our average fundraising was $135 million. So year over year, we had some peaks and some valleys, but year over year, the average was $135 million. In the first year of the campaign's counting, which is fiscal year 21, we were over $252 million. Last year, we raised $316 million. This year today, we're at 220. These numbers show where we were on March 31st, but we've been busy these last few weeks, and we'll talk about that a bit more. And so today, toward the campaign goal, we are at 780 million. And of course, in the next few months, we will go beyond the 800 million mark for the campaign. So I am confident that in this coming year, in fiscal year 24, we will hit the halfway mark at the 1 billion. But that's where we're at. That's what this reflects. The next two slides, it just gets smaller for those of you who couldn't read the previous one, so I apologize about that. The next two slides, again, the first slide on if you're looking at this on the left, it talks about where we were on our fundraising total. And then the second graph that's on the right talks about where we are on student support, because you've heard me say that's one of the things that we're really, really focused on. And despite the fact that we're down a little bit this year on our total activity, we're tracking ahead on student support, and we have some plans in place that we think we can make a significant impact on that goal. So these are the metrics. We look at a lot of metrics, and we look at a lot of metrics every day, but these are the four. You're going to see four charts here. These are the four that we really kind of obsess over, as Guy said. Okay, the next slide, again on the left, smaller, but for you to see, is the number of individuals who are supporting us on an annual basis. So the total number of donors. This at its peak was around 36,000. We see an opportunity in this campaign to get to closer to 50,000. I'll talk a little bit about some of the ways we think we can do that. That is a huge stretch goal. And it's hard to do. And the reality is that just because someone gives 1 year doesn't guarantee they're going to give the next year. And that's the commitment that we have to work toward to ensure that we continue to have people want to be engaged, want to support the university, and feel good about their investments. The slide on the right is a reflection of gifts of $1 million or more. You can see the increase, and that is something that's pretty traditional when you think about a campaign. Campaigns tend to generate activity, and they tend to generate some of the larger transformational gifts. The difference I will tell you about this graph, the reason the last line on that graph is lower is because it's reflecting the value of those $1 million gifts. Last year we closed at over 60 $1 million gifts, but we had one $1 million gift in that amount that was pretty significant. And so we are tracking ahead in terms of number of $1 million gifts, but we're tracking slightly below on the value of those, again, in large part because of that one significant gift. Impact gifts. And so, I could tell you that every gift that happens is an impact gift. And we'll talk a little bit about this as we reflect on Giving Day, which happened 2 weeks ago now, I think. Was it last week? It feels like 2 weeks. So it was last week. At any rate, I know a lot of people think our preference or our priority is around the larger gifts, and it's really, obviously they're important and they play a huge role in what we do, but we really are trying to imagine how every gift can make a difference. The gifts that I've highlighted here were inspirational for a variety of reasons. The Loves Field gift obviously supports women's softball. I don't guess there's probably a person in this state that doesn't love OU women's softball. And this was a gift that allowed us to finally make that commitment to move that team into a new stadium. If you drive up Jenkins, you can see obviously the work that's happening. And we're excited about that. It also was the largest gift for a private gift for a women's sport, which made it a super special gift on a lot of reasons. The other gift here that I noted is an estate gift from Dwayne Andrews and his wife. For those of you who know Dwayne, he had a relationship with the College of Medicine. He served as the former provost, and he and his wife have made a commitment to support students at the College of Medicine. And we're thrilled by that. Obviously, that's a place where we are always going to have a great need. And so he stepped forward and asked to be a part of something in that capacity. The next two gifts that we highlighted, and again, I could highlight countless gifts in this space, but the next two that we highlighted, I am especially intrigued by this motion capture lab. I spent some time actually even just this morning talking to David Brosio about this. This particular lab and this gift has the ability for our students in the College of Fine Arts. There's actually equipment and like a suit. So when students are performing, there are sensors in that suit and all kinds of technology designed in that can allow for animation that you can then transfer those movements into objects. So if we had a dancer who had that suit on and was performing a variety of acts, that dancer could then take that suit off, that technology could be applied, and we could actually turn that into a dragon or a tree or something else that animation would happen then, and it would have an implication for us to be able to manipulate that. That gift is super important because it cuts across a lot of colleges. There's work happening in history, in anthropology, and engineering, and architecture. And so this gift for us is a place in which we can have an impact. And without the campaign, it's probably one of those projects that might not have been brought to our attention. Likewise, the last gift on this slide on the right-hand side for you that can see, but not maybe read it all, is about the commitment from the Oxley Foundation to support the Bedlam Clinic. This is a project that, quite frankly, wouldn't have happened without the Oxley commitment. They pledged $3.5 million and asked us to go match that with $3.5 million. It has huge implications for the community medicine program in Tulsa area. We just celebrated that gift last fall, right around the time we announced the campaign. We had a variety of folks that stepped forward to make that happen. And so it was just a really important project for Tulsa and for the community. We are in the process of reconsidering the naming for the Bedlam Clinic. And our dear friends at Oxley Foundation, who we asked to let us consider naming it in their honor, have declined. They aren't looking for that kind of recognition, but we have an opportunity to do something special there. What I'll say about these gifts, while I could have highlighted hundreds of gifts, I will tell you that, across all of our colleges, we have these kinds of priorities and projects that were defined by the deans or the academic leaders to help us put dollars and costs associated with this to help us have conversations with individuals who might be interested in supporting our work. So for example, at HSC, we're raising dollars for 2 mobile units, one for lung screening and one for mobile mammography unit. In the College of Engineering, we're doing lots of work to raise dollars to help with facilities, the same with Price. Price is growing daily in enrollment, and they just don't have the physical space to support that. We talked about things that are happening in the College of Fine Art. Journalism, for example, we're really being thoughtful and deliberate about expanding and rethinking and recapitalizing the Lindsay and Ask project. And again, that happens because of the campaign. So in every one of the colleges or units or areas that you may have an interest or you may have provided support, we have projects. And these projects, quite frankly, would probably not have been able to be realized or won't be realized if we don't have the success that we're hoping for through the campaign. So that's why each of the colleges and units are coming forward with their own priorities. I'll give you a little sense of, there's a lot of ways to do campaigns, and I've worked at universities where you have a president that says it's my campaign, and these are my priorities, and this is what we're going to raise money for. And it can work, and I've seen it work. Then you have sometimes a campaign where you have a president that says, I don't have any priorities. Whatever everybody else wants to do is fine. And it can work too. It's not great because when a donor looks at your president and says, what are the priorities? And they say, oh, well, whatever you want to do, that's really not compelling. And then you have what we have here, which I think is really the perfect storm. President Harris knows that need-based aid and student support and faculty support is important, and he's going to talk about it consistently. But he said, I want all of the colleges and units to have an opportunity to identify their priorities, and I want this campaign to be about them. And so for us, it's just kind of the perfect storm, and it makes it easier for us to be able to work with our alumni and friends to find opportunities that might be relevant or important to them. This slide, I'm sure now that I know that some of you can't see it, I'll just talk it through. So this slide is about Giving Day. Giving Day, if you didn't get to participate in it this year, don't fret, we're gonna do it again. And I may say that 5 more times. Giving Day is really, it's a super fun day. Many of you are here today because you live locally, so I will say that I will extend an invitation. If you can make yourself available and you can join us on campus next year on Giving Day, you should do it. It's a really spirited day in which we're trying to help people understand the impact of philanthropy. So in 2021, we raised a little over $800,000 in 24 hours, and that's what Giving Days are. Columbia started this trend, and you can see lots of institutions, even now, a lot of K through 12 educational opportunities exist around Giving Day. But everybody is trying to do, most everybody, we joke, I won't miss the opportunity. Texas does 40 hours. Okay. And I'm just saying. And so I did tell Joe Harris this year that this doesn't get to happen very often, but I encouraged him because he was talking to Jay Hartzell the day after Giving Day for us, and it was 2 days after theirs had finished. I said, you should let him know that it took them 48 hours to raise 28% of what we did in 24 hours. Just saying. So, yeah. And so what we ended up with this year, last year we had 11 million. It was a great year. I set the goal for 10 million, and there were lots of panicked faces. And people said, are you nuts? And I'll call one of my colleagues out. If you don't know Risa Brewster, you all should know Risa Brewster. But Risa Brewster sent me the funniest note last year after Giving Day, and it's so Risa. It said, well, I remember few months ago when you told us we were going to raise $10 million, and we all thought, oh, bless your sweet little heart. And she said, I'm sorry, I guess you were right. But it was fun to see this come to life. This year, our goal was 15 million. We raised 22. The real important part for us was that we had participation across all 50 states, and we raised that through 5,000 gifts. That's a place where we're going to be ambitious. I don't know if our dollar amount will increase consistently. I mean, we're going to be pretty focused on around 15 or 20 million because that's a pretty ambitious goal. But we really do want to see ourselves closer to 10,000 gifts in a 24-hour period of time. I say that without making eye contact with Bonnie and the gift processing team, who are still suffering from what happened last week. But they're suffering with smiles, and they've been really good partners in all this front. I want to mention this event to you. One of the things we're really trying to be thoughtful about in this campaign is how do we create opportunities for you to be more engaged with the university? And a campaign gives us a little bit of a platform to do that. Some of you might have had an opportunity to be with us last year at the gala. And I think you'll all agree that we'll never see Lloyd Noble look so nice again. And Guy Patton has agreed that it will never look that nice again based on the budget that he provided. But this event for us, we're going to probably partner with the spring event around All Access. But what we're trying to do is we're going to create an opportunity in the fall in which we are going to host an event on a Friday that we want our alumni and our friends to come back and join us for. There are going to be 3 different tracks of courses that will be happening. They're 1-hour sessions. I call them courses, but they're really 1-hour sessions. And they're going to be really interesting topics. We get to handpick them, so there'll be about 15 or so classes that people can choose from. They're going to range from, I think the one that I find intriguing is entertainers like Dolly Parton and American culture is going to be one of them. Kyle Harper is going to speak to pandemics and the work and the studies that he's invested around the topic of pandemics. We're going to talk to folks about the weather and the role that the University of Oklahoma plays in the weather and the ability to track the weather. Sherry Cole is going to be our keynote speaker at lunch. We're really excited about that. She's going to be promoting the book that she wrote, and she's going to be talking a lot about leadership. So this event is going to happen during the day. You should have gotten a save the date. I just got mine. If you did not, please let us know. Watch for it. We want to make sure everybody's there. And then that evening, the president is going to host a dinner, and it will be an opportunity for him to provide an update on the campaign. So the date is October the 20th. We've locked that in. It turns out it's really hard to get people here to tell you when homecoming is. I didn't know that was such a thing. So this has been a little bit of a moving target, but we're pretty excited about this particular event. I'll also share with you one of the things that I've been working with the president on is the opportunity for the president to travel and host alumni that would like to travel with him. A few of you had an opportunity to be in Scottsdale a few weeks ago with the president for a small golfing event. This particular event is going to happen in the summer of 2024. This cruise is reserved at this moment for the OU family. So this ship, we have about 50 cabins. The ship will be dedicated to OU family and friends who want to make a reservation. At the moment that we get closer to the date, and if we don't have all those rooms reserved, it could get opened up to individuals outside the university, which is fine. But I think that we'll probably be able to make this commitment. It happens July the 9th through the 13th, or 5th through the 13th, my apologies. And so we have information about that. We have some flyers here. We have information online. If you want more information about that, I would encourage you to ask one of us. We'll be sure to get it for you. Again, President Harris and his wife Ashley will be hosting this trip. We already have folks who have registered. I think it's going to be a lot of fun. If you haven't done this type of travel with the president, it's actually a lot of fun because you get a lot of opportunities to do a variety of excursions. We think it's the right amount of time. I've been on these ships, and if you've been on a ship for very long, at the end they start getting smaller as the week goes on, and you can't get away from some of the people on the boat. But this one, we think the timing is just about perfect, and we're excited about this. So I hope you'll consider joining us for this. This slide here I wanted to highlight because many of you have been involved with the President's Associates and you've been supportive of the President's Associates over the years. I'm really excited about Breanne Miller joining our team last year. If you haven't met Breanne yet, I hope you will. Breanne has brought the board back together. Kirk Allen Jones is here. He's been an inspiration for us because he's He's ridden that wave. He's been here when all those dirty words about parking were spoken. And we all know that. That is not something we want to revisit. But I will tell you that this group is really excited and energized about the work that they're doing. The board is much more, I think, deployed in a variety of areas that allows us to have a wider reach. We're going to get really serious about the work here. This group is a part of the Learn On event that we talked about in the fall. It's a co-sponsorship with Osher Lifelong Learning Institute and the President's Associates. So we're really excited to get this group more engaged and make sure that we're recognizing the value that this group brings. When you look at this this population of folks who have supported the President's Associates either currently or over the years, it's startling. I mean, there are many years that I'm certain the university wouldn't have been able to do some of the most important projects or carry forward some of the most important plans without the work of this group and the support. So we're very grateful. We just want to find all the ways that we can to re-energize this group and make sure that we're doing the best we can there. So the last detail I'll share with you is this will make Paul Massad very happy, I hope. We have been very focused in the last couple of years about our work around legacies. And so what we know to be true is we know that there are a lot of people, when they think about their legacy, they imagine a place in which Oklahoma could play a role in that. And in many cases, we believe that individuals have actually shared those details with us, or in some cases not. And we just want to make sure that we have all of that accurately recorded. It's so sad to me when, and we've seen it happen here a few times, when we're announcing an estate gift and we're talking about the impact and you don't have the individuals who made it happen to be there. And that's not what we want. And so what we really want is we want to be able to work with as many people as we can now to understand exactly what your intentions are, exactly what your wishes are, put together a really thoughtful plan, and celebrate that now. It's so much better, it's so much more meaningful, and it allows us to get it perfectly right. It's so hard after someone has passed to try to understand exactly what they wanted and hope that you get it right if you just don't have those details. So this flyer, this visual that you have here, it represents a flyer that's going out. It should hit the mail in the next couple weeks. It's actually going out to about 44,000 people. Every time we do a planned giving mailing, somebody calls me and says, gosh, I'm that old, I got a planned giving mailing for the first time. I'm sorry about that. We tried to be generous in our mailing, so don't take offense. We just want to make sure that we have these details recorded and that we've worked with anyone that has an interest in doing this. So that will happen soon. So any questions that I can answer about what we're doing and the work we're doing? If I could, I just want to ask the folks in advancement that are here. We have a huge representation today. I think you know most of them. I just want to ask my advancement team to stand up. They have been troopers, and it's not always been fun. We've had some highs and lows, and these guys have worked hard to be a part of it. So I'm just going to ask if they will stand up so we can just recognize this group really quickly. I caught Stacy not standing up. No, we have a great group. I'm incredibly grateful for the commitment of the university and the foundation to support this effort. It's a long haul. You know, it's kind of like, I'll say this, Keith Peters can appreciate it. It's kind of like running a marathon, but acting like it's a sprint. And it's hard, you know, it's a long game, and there are going to be times where we all go, oh my gosh, what are we doing? But we're thrilled. We've recruited people from all over the country. And we have a really great team. And so if you're not hearing from someone in the college or the area that you've been interested in or you've supported in the past, please let us know. That's certainly not deliberate. It's an oversight on our part. And we want to make sure that you can have the relationship you want with the university. So without any questions, I'm going to turn it over to my colleague, Brad. Okay.
You know, our team prefers to labor in relative obscurity. So every year I get pulled into this opportunity, but this is the 8th time that I've been able to share an update at the Foundation Forum. And so it's always an honor. You know, we we have the opportunity to oversee all of the investable assets that the foundation is steward over. And today that's about $2.4 billion. And so there isn't a day that we don't, as a team and myself personally, wake up and say, feel very responsible for all of those dollars, but also are just delighted and honored and privileged to be a part of the work of growing those and compounding those dollars in support of the university. So like all of the slides before these, I would just say, however we built them, they weren't intended for all of your eyeballs. So let me just work through the slide, and I apologize that it is a little bit difficult to see. The purpose of our team, in addition to the goals and the priorities of the overall foundation, the purpose of our team is to pursue exceptional investment outcomes that compound each donor's gift in support of the university and its students. And our goal, as simple as it may be, is to generate 1% excess performance over what you could get by investing essentially for free with somebody like Vanguard. And so if you think about that, that doesn't sound particularly noble, but if you can do that, and you can do that consistently over time, there's something magic about compounding capital in support of the university. And so at the bottom of this slide, there's some bubbles. And the takeaway is this. The endowment is currently $1.8 billion. We'll talk about the portion of that is OUs today, and that's where we're really focused. All of it's invested exactly the same way, but nevertheless, if you were to look for 25 years, if you were to compound that capital at 1% net of all fees, so after you've paid everybody, and everybody takes big cuts, as you know, where do you end up? And so it doesn't matter what the market does. You're going to end up at a really special place. The ending market value of the endowment, regardless of the performance of everything else, will be $520 million more than if you were unable to do that. You would have spent along the way an additional $305 million. So the impact of getting this right, organize yourselves professionally and working to generate excess return over the free benchmark is in excess of $800 million over the next 25 years. You can make up all sorts of magic numbers. Why not 2%? Why not 3%? Why not 8%? All of those would be great. But the funny thing about that math is that it works both ways. And so you can always end up 25 years later and be 1% less than the thing that you could have gotten for free. And so you're always balancing how much risk and how much effort you're willing to pursue higher and higher returns. And so this trade-off is a really, really powerful one. But nevertheless, just that tiny number, 1%, is incredibly difficult to do. And so the other piece of our purpose, again, and our long-term goals is to build great relationships. And to do this business well, it just takes great relationships. It takes great relationships with donors, with stakeholders. It takes great relationships with managers. And so along the way, we really want to be exceptional at building relationships that are consequential. So again, don't even try to read it, but let me just give you the key takeaways. So if I'm standing here looking at the investment program over time and the great work that the foundation has done long before I arrived through today, you say, what are the key takeaways? And I'll just tell you a couple of ones that really strike us. Performance is a zero-sum game. There's 300 college endowments. They all want to be the best. They're all trying to win. And it turns out that there's always an average. Half of them are below average and half of them are above average, and that's just the way math works. Math is quite mean. It's a little bit brutal, but at the end of the day, there's above average and below average, and everybody can't be above average. And so the message that in there is, our hope is always to be just a little bit above average, and over time, to compound to be exceptional. And so that is the goal that we have taken and the method that we used. Competition is incredibly fierce. For every winner in the investment markets, there's a loser. And so the pithy way of saying that is that somebody has to donate excess return to us. If we want to have extra return, it means somebody was willing to, or somebody gave that up. I don't think they were willing. And so again, The competition is incredibly fierce. Everywhere we go, you know, we have $2 billion in our pocket and we walk into opportunities, and the most common response that we get when we say we'd love to partner with you is they say, we're full. We already have enough money. And so it's kind of a shocking reality, but there are institutions just like us. They're busy building exceptional relationships as well. Everyone in a similar situation as myself that's standing in front of a similar group like you is saying the exact same thing. We want to be above average. And so it's a really, really competitive game. And then finally, one of the things that I think is most notable and something that we've learned and we talk about all the time is we can do anything at $2 billion, we just can't do everything. And so we need to be very, very careful about prioritizing the places where we can have an impact and where we might have an edge and be competitive in those investment decisions and ultimately generating returns. For instance, when you think about trying to invest in sort of places that are far afield from Oklahoma, we can do that. We have quite a bit of capital in all of those, in many, many places. But can we be experts? Are we going to be the very best investors in Southeast Asia? Maybe. If it were really, really impactful, I think we could organize ourselves that way, but that's an enormous amount of effort. And so when you think about how we're going to spend our time, we'll say, you know what? That seems like a place that's really, really hard. It's very far. It's very expensive. Maybe one day, but probably not now. And so the ability to just say, hey, this place is where we think we can add value, and this place is a place where we'd love to add value, but we just don't think we can, is a really important part of our process. So we can do anything, we can't do everything. So moving on, why do we think we have an advantage? And there's some really, really well-established advantages that we have at the University of Oklahoma Foundation. And the number one benefit and tailwind that we have is a history of excellent governance. And so governance is really, if you think about, we report to an investment committee who ultimately reports to a board of trustees. And in each of those situations, they hold us accountable, they delegate appropriately, and ultimately they've lent support to a key critical decision, which is full-time professional stewardship of the investments of the University of Oklahoma Foundation. And that distinction, you know, at the most basic level, there's a couple of ways that you can decide to generate returns. All of them are correct, and I'll just distinguish what we've chosen. So on one hand, you can put everything that you have in Vanguard, which is a great option, honestly, for many people. You should do that. And in that case, we'd need very little staff, we'd pay very little fees, and we would get the market return, which is very good, and over time is very hard to beat. Another thing you could do is outsource it, and so you could hire somebody, and I don't say this with denigration, but you can hire somebody in New York or Los Angeles to manage all of the capital, and they would pool that with other universities and other pools of capital. And that's a great option. Those people have tremendous scale. They've got a lot of talent. There's nothing wrong with that option. But we chose a different path, which is to have full-time professional stewardship overseeing the assets. And the only job of the investment staff at the University of Oklahoma Foundation is to wake up every day and care about the University of Oklahoma Foundation's assets. We don't have any other conflicts of interest. We spend no time on anything else. And so that is a decision that Guy and the board made back in 2007 when he joined. And that's a decision that the governance body has been committed to ever since then. The second piece is a commitment to full-time professional staff. And so in this, following Amy's lead, I'll just pause for a moment. So with the investment team, everybody who works on the team, stand up for just a moment. I remind our committee of this all the time because I have to remind myself, but this is what we do all day long. And it's kind of remarkable that it takes all of these people to just oversee this pool of capital. But every single day we're busy from morning until night, making sure that we have all of our ducks in a row, that we have the information organized, and that we're building exceptional investments to put capital to work. It's really a tremendous amount of effort, and we're honored to do it. And then finally, we are professionally staffed at all levels. And so when we decide that we are going to do something, we have the appropriate staffing and the appropriate experience to make really powerful inroads into those opportunities. And so it's really privilege, and that's something that we have historically, over the course of time, have dedicated ourselves to, which is to be professionally staffed at all levels of the organization. It's been almost a 15-year process getting to this point, and so we've done it very consistently, very carefully over a long period of time. Over time, we've relied on consultants, we've relied on advisors, and we always rely on external managers. But nevertheless, as time has progressed, we've arrived at a point that we think, again, where our professional staffing has allowed us to be very impactful in the areas that we decide to spend our time. So it's really, again, an honor and a privilege, and the governance has been a primary driver. I could stand up here for a long time and tell stories about bad governance, but the worst version of this everybody knows, which is I lost some money, I got to sell everything. Like that, and that's real, and it happens to many institutions. So at the far end, you have a governance body that doesn't trust the process. And so I would just looking ahead, there's no doubt that we will be tested in some way for a variety of reasons. And so we have a great deal of confidence that the work that we're doing is consistent with what the body of oversight wants, and that we will be able to handle and navigate some really difficult circumstances if and when they come along. So moving on to results. So what you're looking at and the things that you can't see are bubbles, and they are covering the fiscal year 22. So this is the results going back in time. This is results for June 30th of last year. And so the way that we always report at the forum, but also, the way that information is reported to us, we don't actually exactly know how we are doing. We know broadly how we're doing, but we don't know the exact numbers for a period of time. It takes a long time to actually figure out what ultimate performance will be. So we always report on last year's fiscal return, and this is the data we have not only for our group, but we have for peer institutions as well. So if you today, maybe the equity market's up about 7% from this period of time, so it's been a little bit better, but last year was a pretty tough year for a variety of reasons. Stocks were down 16%, bonds were down 11%, and inflation was up 9%. And so that's the worst combination of investment results. And it was a no fun, whatever Dr. Seuss says, rotten, no good for nothing kind of a year. And surprising on many, many levels. But I think that over time, the returns from bonds in particular were really, really poor. And with stocks and bonds being down, there wasn't a lot of places to hide and protect capital. I think that this is the worst bond market. It was the worst bond market return in decades, for sure. People use all sorts of things. I'm going to pretend that, many, many decades, if not hundreds of years. So it was a really, really tough environment. Not a lot of places to hide. And so with that as context, we'll talk about our return. So the endowment was down 7.5%. And we ended the year, the OU portion of the endowment was $1.62 billion at the end of the year. And we lost $125 million of principal. From a mark-to-market perspective. Those are not permanent impairments, but that from a mark-to-market perspective, we were down about $125 million. Nevertheless, we, as you recall, we spend 4.5% of the endowment every year in support of the university, specifically in support of donor intent. So scholarships, faculty support, facility support. We were able to send $65 million to the operating budget of the university. And that represents about 5% of Norman campus's budget, but less than 3% of the overall OU budget, including health sciences. So it is a consequential drop in the bucket. And we would love that number to be much higher over time. And that's a really important part of both the campaign and the investment performance that we can generate. Again, here is results. Here are results. And so you have the endowment at the top line, and then you have sort of how we measure performance. And then ultimately you have our long-term target, so starting with the endowment performance over 5 years, I'll go to the far column. We've earned about 9.3% compounded annually. Our policy benchmark, which is our primary point of reference, generated about 5.4% over that period of time. And then the ultimate question is, were we able to spend 4.5% a year and keep up with inflation in order to maintain the purchasing power of each gift to the endowment? And that is reflected as the long-term target. And so when there was no inflation for the last 5 years prior to this moment, that was a fairly easy thing to do, and we generated a tremendous amount of excess performance. Given both the loss of capital from the endowment as well as inflation, all of a sudden that becomes a much more difficult number. And so if you look over time, our 5-year number is 9.3. The long-term target is actually 9.5. So while we looked like we were sort of the tortoise and the hare sprinting ahead over the last 5 years, inflation is a tricky thing, and it's a really tough thing to manage. And so all of a sudden we look like we're supposed to. So we're essentially generating the return that we need to preserve purchasing power. It ebbs and flows, and so next year it could be different, but at the end of the day, the long-term goal is to make sure that we are generating a positive real return for the endowment. This, again, this tiny little chart here is our peer comparison. So we're just asking the question. This is about 150 different peers. This would be public schools and private schools. This would include everybody that you would imagine. This is Yale and Harvard and Stanford and OU. And so if you ask the question, how have we done over time? The answer is really, really good. And I think everybody should be really, really thrilled that the stewardship of the gifts that each of our participants have been managed in a way that I think that they should all be proud of. About average over the year, above average over 3 years, and above average over 5 years. And ultimately, if you ask the question over the last 10 years, really, really good. So our goal over time is it's not our goal, but we would love to be sort of in the top 25% of endowments, including private and public. And if you look at our 10-year results, we are certainly in the top quartile of performance. But I think more importantly and more relevant to us, there's only 2 public universities in the country that have generated a higher return over the last decade. And so there is actually a pretty substantial difference between the work that private schools do on their endowment versus public schools. And so relative to public schools, we've done really, really well. Relative to everybody, we've done really, really well. So that's a great message, and it's an important one, and it is a credit to both the team, but also really just a credit to the commitment that the foundation has made over time to be exceptional. Just so you know, the chart here asks the question, how are we invested? And so this is our policy. And so the big red portion of that is essentially equity. The slightly larger dark gray portion is super equity. So really, really sort of punchy equity. And then the little gray slice is things like fixed income or safe assets. And so what you should see immediately, if you add up the red pie and the dark gray pie, you get to a lot of stocks. And so it should not be lost on anybody that we invest heavily in stocks, and we rely heavily on the process of equity investments to generate our returns. The tiny little gray portion is what we think we need to make sure that we can survive a difficult period of time in a bear market. But otherwise, the goals that we set for ourselves, which is 5.5% real, after inflation, there's really only one way to get there, and it's a bumpy and a little bit of a scary ride. and it really is heavily invested in the stock market. So we are stock market investors, and you can always think about the endowment in pretty simple terms, which is if the stock market is doing great, we're doing great. If the stock market is not doing great, we're not doing great. And so it's a long ride. And again, when you think about governance, the folks that are overseeing the process, including us, need to be very comfortable with the fact that you don't get it all at once. It happens over a long period of time, and you try to take care of every detail along the way. This is how we're currently invested by a different description. And so from left to right, it's private investment. So this is all forms of private equity and private investment structures. The next one is just stock market investments, which you'd be familiar with in forms of things like mutual funds. Alternative investments is about 11% of the portfolio. This would be broadly defined as things like hedge funds. As you move over, the fourth box there is real assets. We separated that out here. This is, largely energy type investments. And then finally, you have absolute return in bonds. So this is the diversifying kind of stuff that you hope will be available to you in a difficult period of time. So that's our current investment. And these are our areas of focus. These are places where we think we can either, that we have consequential skill at present, or places where we will work to build and generate a set of skills that allows us to have an edge and be competitive in these markets. And so I'll just say them out loud. So venture capital, so startup, technology-based ecosystems, US buyouts, which would be your traditional private equity. Energy transition, this is a place where we will spend time, but we don't have any current expertise in this space. Things that are broadly defined as hedge funds, we think particularly private equity structures in Europe are compelling at the moment. Absolute return, which is just a pithy version of a way to invest without a lot of market exposure. So the direction of the stock market isn't necessarily correlated with the underlying investment. We have private credit, US growth equity, and then biotech. So those are just broadly the themes that we spend most of our time on. They shift every year. They may change. Some things might fall out. But at the end of the day, the first question is it worth our time? And the second question is, if it was, could we actually do it? And the answer to those things are very, very important. So with that, two things will happen. I will pause for a moment and answer any questions that you have. And then we'll transition to our Deputy CIO, Gene Lohmeyer, who'll give you a market update. And that's really starting from sort of today. So what's happening today in the markets? Again, it'll be difficult to read the charts. And so he'll just walk through the key themes of how we are viewing the opportunity set in the markets today. So with that, I'll just pause and happy to answer any questions that you might have. The investment strategies that we have is international by design. So our benchmark is about 32 to 35% international. And so our investment pool is going to be roughly 32 to 35% international. So assets that are not in the US. Yeah. The question is, do you have any rules or policies about saving the environment? Fair question. It is a hotly debated topic. And one of our strategic priorities is to sort of put down in words how we think about that question, along with many others. At the end of the day, the way that we think about this currently is we have no interest in investing with people that are trying to destroy the environment. I think the debate on what that means is hotly contested. And so I can tell you that our view, when you think about the energy transition theme as an example, I think there's no way to get to something perfect without using the resources that we currently have. And so when we think about the broad spectrum of the energy transition, which very much dovetails with the idea of having clean environment, our general philosophy is to have a long view and to make sure that we have all of the resources that we need today to bridge the gap into a much more interesting future. So from an investment perspective, we have the opportunity to look at each of the sort of stages that ultimate energy transition will take and try to allocate our capital in ways that we think will make that happen both profitably and in a way that makes sense. Any other questions? Okay, I will transition to Gene. Thank you very much for your time.
All right. Let me make sure how to work this thing. Yep, pretty simple. Thank you, Brad. It's wonderful to be with you all. This part of our presentation will run 10 to 15 minutes. I better stay in one spot. Before we jump into our slides, first just a few quick high-level thoughts. The past year or so in financial markets has been all about inflation and the efforts of central bankers around the world to fight inflation by increasing interest rates and draining liquidity from the global financial system. What we do know at this point is that inflationary pressures are definitely starting to abate. What we don't know is how much collateral damage has been inflicted upon the economy and how much inflation will stay with us over the medium to long term. In other words, what will the new normal be for inflation going forward? So with all that in mind, let's go ahead and dive into the slides, which again are small, so I'll be as descriptive as possible. On this slide, we show total returns of major asset classes, including equities in red, real assets in gray, and fixed income in blue, moving from left to right. In the top exhibit, we show returns as of the most recent calendar quarter, ending on March 31st. And in the bottom exhibit, we show performance for the trailing one-year period. So starting with Q1 returns in the top exhibit, virtually all financial assets rallied during Q1 as global financial conditions became slightly less restrictive. Within global equities, developed international stocks outperformed the US. This was largely due to currency effects as the US dollar depreciated about 2% against a basket of currencies. Within real assets, shifting to the right a bit, commodities were a relative underperformer. As is often the case, there was lots of return dispersion within the commodity complex. This information isn't shown here. You probably couldn't see it if it were. But a basket of energy-related commodities was down about 18% during this period. Meanwhile, precious metals, including gold and silver, delivered mid-single-digit positive returns. Shifting focus to the bottom exhibit, and alluding to some of Brad's comments, basically every asset class lost money over the prior one-year period. And the main culprit here, of course, is stubbornly high inflation and rising interest rates. For context, the 10-year U.S. Treasury yield was approximately 2.3% as of April 1st, 2022, but increased to a high of 4.2% during this period. Continuing on that point, these exhibits further illustrate the fact that changes in real interest rates were the predominant driver of both global equity and fixed income markets over the past year or so. So within these exhibits, we show the index price levels for global equities and bonds as the gold line, and real interest rates as the red line. So real interest rates are shown here as the yield on US inflation-linked bonds and are shown as inverted. So going from top to bottom actually means that interest rates are increasing. So the overarching point here is the very tight relationship between changes in real interest rates and the valuations of not only stocks and bonds, but really all financial assets. On this exhibit, we show the returns of several size and style factors within equity markets. There's a ton of information here. I would direct your focus to the exhibit or the table on the right, where we show the relative performance rankings of each of these style factors within global, US, developed international, and emerging markets. As you can see in the areas circled in red, growth and momentum were pretty much the worst performing style factors across the board. Because growth companies derive a greater share of their profits further into the future, the stocks of these companies are particularly negatively impacted by changes in, or more specifically, increases in interest rates, because this reduces the net present value of those future cash flows in today's dollars. As you can also see in the area circled in blue, the high dividend yield factor was one of the better performing areas. So the types of companies that comprise this style index include the likes of Coca-Cola, Procter & Gamble, and Johnson & Johnson. So these are relatively mature, large companies that offer a very consistent dividend yield. So when you consider the relative underperformance of the growth factor and the relative outperformance of the high dividend yield factor, the equity markets have essentially favored stable near-term cash flows at the expense of more speculative cash flows received and priced further into the future. One of the reasons that equity markets have favored more defensive companies is economic uncertainty, resulting from inflation, among other factors. So over the next couple of slides, we'll touch on some of the drivers of inflation, beginning here with the labor market. So in the left-hand exhibit here, we show the total number of unemployed workers here in the US. And in the middle exhibit, we show the number of job openings. And in the far right exhibit, we show the ratio of job openings to unemployed workers, which is an indicator of labor market tightness. As you can see in the far right exhibit, this ratio peaked at roughly 2 job openings for every unemployed worker last year, and has since stopped increasing and started to come down a bit. So this indicates that labor markets are still pretty tight, but not as overheated as they were, say, this time last year. Referring again to the far left and middle exhibits, the number of unemployed workers is about what it was prior to the pandemic here in the US, but the number of job openings shown in the middle exhibit remains quite elevated. So this is one reason that some experts believe that we could avoid a recession. In theory, it's possible to achieve less tight conditions in the labor market through a reduction in the number of job openings as opposed to actual job losses. Here we show a handful of additional inflation-related exhibits. These more focused on the residential real estate market, which is relevant given that shelter comprises approximately 40% of core inflation. And the data is pretty straightforward here. Beginning on the far left, existing home sales have plummeted here in the US and are now at levels that we haven't seen since the global financial crisis. And referring to the middle and right exhibits, pricing data for single-family homes and single-family rentals have also started to roll over. So this is obviously not great news for the owners of these assets, but the silver lining is this is pretty clear evidence that inflationary pressures are, as we say here, beginning to subside. Notwithstanding pretty clear evidence that the inflation outlook is improving, at least here in the US, policymakers are nonetheless very cognizant of the risk that inflation becomes more deeply embedded and self-reinforcing. So in this exhibit, we're showing consumer price inflation and the federal funds rate throughout the 1960s, 70s, and 80s. As you can see, inflation was above 5% throughout most of the late 1960s and 1970s, and eventually peaked at around 15% in 1980. With the benefit of hindsight, the Federal Reserve has been criticized for a series of policy reversals that many feel contributed to the runaway inflation of the late 1970s. More specifically, there were 4 separate instances between 1969 and 1981 in which the Fed funds rate peaked and then subsequently declined by 2 percentage points or more. As you can also see toward the right-hand side of this exhibit, after inflation started to come down, the Fed funds rate remained above the rate of inflation for many years. So with this historical example in mind, policymakers have expressed their commitment to not only increase interest rates as necessary in the very near term, but to maintain interest rates at elevated levels for a longer period if necessary. On a somewhat related note, one of the major news headlines during Q1 was turmoil in the financial sector, which of course included the failures of Silicon Valley Bank and Signature Bank here in the US, and the distressed acquisition of Credit Suisse in Europe. One of the drivers of this or causes of this was deposit flight, which is a natural outcome of savers moving their cash from demand deposit accounts to money market funds and other higher yielding options as interest rates have increased. Notwithstanding the fact that there have been a few casualties, it's worth emphasizing that current conditions within the financial sector are not similar to those that brought about the global financial crisis. To illustrate this point, in the upper right exhibit here, we show pricing for credit default swaps for a number of prominent US financial institutions. And as you can see, a default risk did increase in March. However, the bottom exhibit puts this in context. So the entire period referenced in the top exhibit, and I actually had a circle on this, it isn't showing up for some reason, but corresponds to this very tiny area on the far right of the bottom exhibit. So as you can clearly see, the increase in default risk that we saw in March pales in comparison to the spike in CDS spreads that accompanied the global financial crisis in 2008 and 2009, and after that, the European sovereign debt crisis in 2011 and 12. So we don't think that we're on the verge of a systemic meltdown within the global financial system, but nonetheless, the lending environment and financial conditions more broadly have become more restrictive. So in this exhibit, we're showing the results of a periodic survey of chief financial officers conducted by Deloitte, focusing on credit availability. The main takeaway here is that the number of respondents indicating that that credit is either easily available or somewhat available has declined significantly over the past 12 to 18 months. Meanwhile, the number of respondents indicating that credit is either very hard to get or somewhat hard to get has increased. In addition to availability of credit, a related concern is the risk that we'll see an increase in defaults among corporate borrowers. So these exhibits sort of share the projections from Standard & Poor's with regard to calendar year 2023 default rates in both the United States and Europe. And the upshot here is that in 5 of 6 scenarios, defaults are expected to increase year over year. One particular area of concern within credit markets and within financial markets more broadly is commercial real estate, and more specifically, office properties. So in the left-hand exhibit here, we show US office vacancy rate, which has increased significantly over the past several quarters and is now similar to what we saw during the depths of the pandemic. In the right-hand exhibit, we show credit spreads for CMBS, which are pools of commercial mortgages. So the main takeaway here is that as office vacancy rates have increased, borrowing costs have also increased, not only because of a broad increase in interest rates, but also because of wider credit spreads, which are required in order to compensate lenders for default risk. Continuing on that thread, here we show weekly cumulative issuance for non-agency CMBS in the US on the left-hand side, and global CMBS issuance by calendar year in the right-hand exhibit. So the clear takeaway here is that CMBS issuance, in other words, borrowing, has declined significantly compared to prior years. This is a key financing market for real estate asset owners. So if this trend were to continue, it would inevitably result in additional stress and potentially a wave of defaults. So this is an area that we're thinking about, and for what it's worth, the most profitable investment in the history of our investment program was an investment somewhat related to this area that we made in the depths of the financial crisis. So we're watching this very closely. So those are our prepared comments for today. I will take a few questions. I think we have a couple of minutes, so we'd love to entertain any questions that members of the group have. How many shoes are dropping? It's a great question. So I guess I love that. Hopefully, well, the way that I would think about that, the way that we're thinking about that is monetary policy, and it's worth mentioning that the increase in interest rates and the more restrictive set of policies that have been enacted over the past year are really significant by historic standards. We haven't seen anything like this in a while. The other thing to keep in mind is that the impact of those changes, of increases in interest rates and everything that goes with that, are lagged and variable, meaning that they take a while to take effect and they don't work the same way in every cycle, right? So back to my comments earlier, we don't know what the extent of the collateral damage is. There's something called the sacrifice ratio, meaning how many eggs do you have to break to make inflation go away. And we're now at the point where the initial impact was to just valuations because of the discount rate effect of higher interest rates. Now you're starting to feel it in the real economy. And we're starting to see, kind of secondary explosions in the banking sector and, commercial real estate and so forth. So this is a process, and it happens pretty much with every meaningful Fed tightening cycle. The great news is, the consensus view is that we have the tools to contain financial accidents, right? The banking sector globally has far less leverage than it did going into the financial crisis, and we have the kind of macro-prudential tools in place to, I think, continue on the path and eradicate inflation and come out of this in much better shape. That's my personal opinion, but there will be collateral damage along the way. How much water should we pack? That's actually a different subject. I'm giving a seminar on that this afternoon. I appreciate the question, though. Yes, sir. Yeah, well, again, it is probably the most significant fault line emerging and the most significant shoe that we can see as far as its potential impact and the number of people involved and impacted by distress in that area. It is an area where we've had substantial success investing in a distressed capacity over the prior cycle. We have not made, actually, if I'm not mistaken, a commitment to real estate private equity since 2015. So we haven't been involved in this space for quite some time, but we've, I think it's an area of potential opportunity for us. So in the spirit of telling you what's on our minds, this is on our minds. Right. Right. It's very real. Yeah. Well, what's particularly unique is you have a cyclical downturn in the economy more broadly that's playing out, arguably. And then you have longer term secular forces resulting from the pandemic and digitalization and work from home and everything that you're describing. So never in history have these sort of factors come together to impact office real estate. So it's very unique, and the distress could be profound. And again, we're not involved, haven't been involved in a significant way for some time, but history suggests that during moments like this, opportunities eventually emerge. So this is one of several areas that we'll have our eye on. Sir. Yeah, it's a possibility. I will say that most of the financing for large trophy office properties in central business district areas don't necessarily come from regional banks. They come from the CMBS market, or they come from large insurance companies or private credit funds. So a lot of the commercial real estate projects financed by regional banks are strip malls and multifamily. Comparatively speaking. So it's not like everything is completely tied together, but the practical matter is, the real estate market is interconnected, right? And the credit markets are interconnected. And it's difficult to foresee the spillover effects and the linkages between these markets because I for one, don't believe that they're completely segmented. So I think that's sort of a billion-dollar question, to be honest. Only $1 billion. Sir? Yeah, it could mean a number of things. And there have been periods, long stretches in capital markets history where the dollar has devalued relative to other currencies. One of the immediate implications is the value of being diversified geographically and holding non-US assets is greater, right? And we saw that. I wasn't involved here at the time, but I was in this business. But in the early mid 2000s, it was very important to be, internationally diversified. And that is an area where we're working very hard currently to make sure not only that we have broad geographic diversification, but that we have, the right partners in overseas markets. So that's probably the biggest takeaway. We don't really speculate on currencies. That's kind of outside of our core competency. But I guess a somewhat related consideration is that a weakening dollar does invite more inflation. So it does change at the margin our outlook for inflation and kind of what we think the run rate will be longer term. If there are no other questions, I'll turn it back over to Guy. Thank you.
Good job. Well, again, whoa, hello, there we go. Excuse me. We did allow for, because you won't know what section we're on, or I can't move the clicker. Somebody drive for me. Well, if I could move the slides, it would say questions. So imagine, you couldn't read it anyway, but if questions. So we're wrapping up, but I'm open to taking any additional questions you guys might have. Okay. Yep. That's correct. Where is it? Yeah. Oh, that's a good question. So the question is, first, a little bit of context. It's related to endowed chairs and professorships, and there was a program that has since retired, and it changed materially in 2008, and then retired altogether 3 years ago, where the state would match private gifts that would endow professorships and chairs, in our case at the University of Oklahoma. The match money that came from the state, Oklahoma State Regents for Higher Education, actually continued to be managed by them. So we literally have like a shadow accounting system that we track the state regents money that matched the private money, and they're attached to funds here at the foundation. It's been a while since we looked at investment returns for the state regents, but generally speaking, we've outperformed their investment results. Their investment results have been good. I think ours have been exceptional, and so we're a little ahead of them in that regard. But that money's still in place, still working really, really hard to support endowed chairs and professorships on all 3 campuses of the university. Any other questions? That was a good question. Those kinds of questions are okay. Well, any kind are okay, but you said it was a little different, so. Well, with that, I will, sorry. Oh, there we go. Okay. Yeah, sorry. So we'd retire the investment department and leave it to AI. That's not what you're suggesting, though. We shouldn't probably do that. We We don't. I think there's no doubt, and Brad could probably speak to it. There's no doubt that we have investments, largely probably through venture capital, our venture capital partners that are both helping develop, but also leveraging the use of AI. AI is actually starting to make its way into the fundraising realm. And so we see a little bit of that in that part of our world as well. I can say that as we sit here today, the foundation is not using AI to either duplicate or enhance any of our work processes. So that said, I think that we're starting to get some glimpses into some possibilities that probably in the very near future we can, at a minimum, leverage AI to improve our existing work processes, both from a quality perspective and maybe even also an efficiency perspective. The potential is enormous, if not a little scary. So that's a long. Okay, any more that I'm not seeing? You guys, keen eyeballs. Okay, well then I'll transition to the thank you. We really appreciate you coming out on this kind of miserable day. What a great facility, except for you can't see the slides. And so we'll certainly take note of that for next year, and we hope that you'll all join us again next year. So thank you for coming.